So we'll head towards the next panel discussions. The topic is Lloyd and Indian InsurTech collaborating for growth. AI is the topic of the year and possibility for the next decade. It's going to be like that. Gen AI is the current avatar of it and flavor of the day. Can we use it on existing insurance risk models? And we will hear from our experts. Our first panelist is James Rendell, CEO of Birdseyeview Technology. He's ex-Lloyd reinsurer broker from the aviation and aerospace market. Founded Birdseyeview in 2021, a European space agency funded InsurTech to provide natural catastrophe and climate modeling to reinsurers, brokers, and MGAs. Welcome, James. Our second speaker is James Robinson, founder of Cactus Limited, the company behind Marmalade, a 2021 launched software that helps underwriters process hundreds of millions in premiums every year. He's a Cambridge Math graduate. Our third speaker is Benedict Altier, co-founder and CEO of Catx Global. It's a Y Combinator and Lloyd's lab-backed company that connects institutional investors, including pension funds, hedge funds, and structured credit funds. Welcome. Our fourth speaker is Milan Naik. Milan Naik is here from Box Insurance. He's a president, Asia, Middle East, and Global Affinity Lead. Milan has 20 years of experience in corporate world across consulting and insurance. In 2017, he founded Goals 101, his first entrepreneur venture, which he recently got acquired by M2P FinTech. And our last speaker is Milan here? Yeah, coming. Our last speaker is Harry Croydon, co-founder and CEO of MIC Global, a full-stack embedded micro insurance company proposed built to transform the insurance industry by integrating simple and relevant micro insurance products with platform partners to provide protection for their customers and service providers. And then we have our moderator, Shankar Garigiparthy, CEO and country managers of Lloyd India. He has total 30 years of experience in financial service industry and has been responsible for setting up Lloyd's in India. Welcome, all of you. Over to you, Shankar.
Well, good afternoon, everybody, and thank you to the InsurTech Association of India, Prerak and the team. And also thank you to my esteemed panel who've very kindly and graciously traveled all the way from different parts of the world, from Bermuda to the US to UK. And our fifth panelist will be joining us shortly. He's delivering his session next door. Milan will be joining us any minute now. But a lot of you just probably are thinking, what's Lloyd's? Lloyd's is probably one of the world's best known brand, but the least understood. So we are a 335-year-old marketplace. We were the first to issue a motor policy back in 1904. We were the first to issue a aviation policy, a satellite policy. Most recently, cyber and drone and anything and everything that moves, including the sun, probably. So we're a marketplace. We're not a company. We don't have any shareholders, unlike what most people know. But we essentially are just like any other marketplace. The Lloyd's building today is still the last physical exchange that stands where underwriters, brokers interact and place business from around 200 countries around the world. The Lloyd's Lab was essentially a concept that was put together about 13 years ago, if I remember correctly. So it was basically started as an initiative where Lloyd's would talk to some of the brightest minds in the tech space and try and see how they can come up with innovative products and solutions or suggestions in terms of how we can do better, and either in the form of underwriting, in the form of claims, in the form of modeling, and what is it that we can do in terms of enhancing our product offering to the client. So essentially the way it works is people apply. We have every year on average, we have over 200 applications that come in. Those are then filtered down to about 20. And these 20 applicants will then make a pitch to the market in terms of what it is that their product offering is. The market will then filter it down to about 10, and those 10 are given 10 weeks of time at the Lloyd's building with mentors from the Lloyd's managing agents who effectively come and support them in terms of expertise through underwriting, claims, etc. And then at the end of the 10 weeks, they then essentially provide a proof of their concept back to the market and say, this is what our product can offer. And then the market chooses one for them to say, okay, we are now ready to support this particular product to go forward. The people that I have here are my esteemed alumni who've gone through the Lloyd's Lab, who've worked with us, who support us, and they continue to work with us in this space. So these are just some very simple numbers in terms of how many cohorts we've had. The 13th cohort is currently going on. They're doing their pitch very shortly. So once that comes on, we'll have 13 cohorts that happen. And then you've got who we are here, but we won't waste any time. Let me now introduce James Rendell, who will essentially provide a bird's eye view of what his product is all about.
Can people hear me? Very punny, Shankar. Good afternoon, everyone. Thank you very much for coming. I suppose not the sellout crowd we're hoping for, but I can assume that everyone's waiting at the bar for the 6 o'clock curfew to end. So, yeah, my name is James Rendell. I'm the founder and CEO of Birdseyeview. A very quick overview of who we are and what we do. So we're an insurance technology company. We have an office in London and one in Delhi, mainly funded by the European Space Agency. And our value proposition is very simple. I don't know, there should be a demonstration going on behind me very shortly. Coming now. So we license natural catastrophe and hazard modeling software to insurance companies and brokers, syndicates like Liberty Specialty, AXA XL, Aviva, Allianz, brokers like Aon and Marsh. And it's very simple. So if I'm an underwriter and I am writing commercial property, construction, energy and renewables, or large special events, what is it I'm worried about when I'm underwriting? The main thing I'm worried about when pricing is, look, I'm insuring this commercial property. Is it going to get hit by a flood, wildfire, tropical cyclone, etc., etc.? That's the main thing I'm worried about when pricing. So what we license them is a piece of software. It's called Weather Analytics. Underwriters log in when pricing and underwriting, and this system calculates the probability of X flood, wildfire, tropical cyclone, etc. occurring at that location when the risk is insured. So if I give an example of work we do in India, so AXA XL, they underwrite the IPL Cricket League, and that is underwritten using our software. Very, very simple. I've been told that we are actually doing Coldplay coming to Mumbai shortly. So that's underwritten using our software. Very simple, because that's the main exposure. Air quality is another big one. I'm heading to Delhi after. That's another big consideration for underwriters for large special events. What's the likelihood it's going to be cancelled due to air quality? That's all provided in our software. So that's a very, very, I think the value proposition is very straightforward. We do one thing and one thing only, and that is natural catastrophe and hazard modeling. Very simple software, team of underwriters log on, calculate the likelihood of a flood, tropical cyclone, all available perils you could think of. Thank you very much.
Great stuff. Thanks, James. On to James Robinson. James, do you want to just highlight what your product is?
No. I would like to thank everybody for coming in today on a public holiday. I think that's, you must be the very keen people. I'd much rather have a handful of people who are interested than how many people aren't. So my name's James. I'm the CEO and founder of Cactus. We solve the prickly problems of insurance and risk. And And the key problem that we're solving is that the insurance industry is a $2.4 trillion industry without an agreed way to share information. And I think that this particularly leads to substantial underserving of markets where there is any kind of cultural difference or language barrier, because it means that if there's if you can't share the kind of raw data about the risk they're being insured, it becomes very difficult to get capital provided to the people who actually understand the detailed risks on the ground. So another way of thinking about that is if you were in financial services, obviously there's a Bloomberg terminal, and so that's what we're trying to build at the moment. And the platform that we've built lets underwriters and brokers do three things. Basically, it lets them capture and compare the key facts about those risks they're looking to get insurance, and then communicate the information on the Cactus platform. And one of the differences about the approach we've taken is we're not trying to disintermediate anybody. So if you are ever pitching VCs like the group that are on the stage beforehand, if the VCs have an insurance background, then they will absolutely. What I've tended to find is they fall into two camps. They either say, this can't be done unless you get Aon and Marsh on board, or they say, why aren't you trying to disintermediate the brokers? And as I don't know what it's like in India, but if I'm trying to buy insurance for my company, the relationship that I've built with my broker means if someone came along with a 10% discount, I wouldn't switch because I actually trust that he's going to get the claims paid. So we built this platform Marmalade that sits on top of the Cactus platform, and that lets us that let an MGA that started recently write over $100 million of premium in their first 6 months, which was 3 times what they expected to. And we think that there's big opportunity, like I said, in the Indian and APAC market generally, to connect the data through to those capital providers, and also to connect capital providers in APAC onto the London and US markets as well. Yeah, so that's us. And yeah, we solve the particular problems of insurance and risk, and I'm looking forward to answering any questions about the Lloyd's Lab and how you guys can get involved. And I'd strongly encourage anyone that has any interest in doing that to apply. There's no downside to applying.
Thank you. Thanks, James. Benedict?
Hello, everyone. My name is Benedict Altier. I'm co-founder and CEO of a company called Catx. I'm not sure if I have slides, so if I may have slides, or I may have a video. We'll see. But in the meantime, to give you some background on what we do, we essentially focus on bringing new capital to insurance. So this is a critical element of the insurance value chain. If there's a big catastrophic event, who's going to pay for it? And the problem that we see today in the insurance industry is risk is highly concentrated among reinsurers and insurers. And especially for these really big catastrophic risks like hurricane in Florida, big cyber events, huge catastrophic earthquakes, all of the big reinsurance companies in the world are already highly exposed to these kinds of risks. So there's only so much risk, additional risk they can assume. And what that leads to is increase in pricing. And we've seen that with the hard pricing markets that exist in the US, where the cost of coverage and the cost of protection from hurricanes is incredibly high. But we also see it in the cost for risks like earthquakes, where there are significant protection gaps all over the world. So our mission is to bring in new capital to find other areas of the economy that might be interested in holding insurance risk. And this is quite attractive for other non-insurance financial services companies because it gives them access to an asset class that is uncorrelated with the things that they traditionally invest in, like equities and bonds. So the chance of a big Wall Street crash like style financial crisis happening at the exact same time as a big hurricane is incredibly low. And the rates, as I mentioned, are very attractive. But the big missing piece, and it's something that it's interesting to hear what James is talking about, and I'm sure we'll get onto the panel around data, is understanding this risk. So we work with more than 45 funds, structured credit, hedge funds, pension funds, family offices, with more than 600 billion in assets under management. We give them access to opportunities from all the big brokers, Aon, Gallagher, and then crucially, we give them vehicles that they can invest in, based out of Bermuda, but also all of the information they need to understand insurance risk. So even if the cash flows are attractive and they might really want to participate, the missing piece in the past has been understanding that risk, getting access to the modeling, really getting a sense of what they're signing themselves up for. We work with Verisk, RMS, Cybercube, Riask, NASDAQ, all of the big modeling companies give access to all the models in one place in a clear, understandable way, kind of Google Translate of insurance risk for new capital coming in. And by doing that, we can cover new risks. We can help to bring down pricing for things like hurricanes in Florida, and help to try and spread risk across the maximum number of people, which really is the goal of insurance. It's about spreading the burden of risk. 100 billion of losses is massive for any one industry, and insurance is no exception, but spread across the broader economy. It's, you see $100 billion swings on most stock exchanges every single day. So that's our mission. That's what we want to do, and look forward to getting into how we can work together and how we work with Lloyd's and the Indian market and the rest of the panel.
Awesome. Thanks, Benedict. Harry?
Hi, I'm Harry Croydon, the COO and co-founder of MIC Global. We started the company about 4 years ago with a mission to bring micro embedded insurance to the new kind of economy that has been growing since about 2008. These are the sort of platform providers like Airbnbs and Ola's, these sorts of companies. And our mission is to embed our insurance into their sort of value chain and to give their drivers and their customers insurance that they need. So typically insurance is pushed to customers. You have to buy it, you're told to buy it. And insurance products are kind of incredibly complicated, but we distill down the products to be quite simple products and then embed them into the actual sales process of that customer. So the customer can pull a relevant, logical kind of product, a simple product, at the point of sale, just as they're buying a trip, or they're buying a ticket, or they're buying some other some other process like booking a hotel room or booking a Airbnb sort of room, or taking a trip. So that's kind of what we do. And we are a technology-led insurance company, which is kind of quite a rare thing. We have all our own tech stack, and we have capacity and the ability to write the insurance ourselves. We're a cover holder at Lloyd's, we're a syndicate at Lloyd's, and we've also got 2 other offshore insurance companies, which means that we can write a range of products around the world. We have offices in India. I've been in India for about 15 years off and on, doing what I used to call insurance technology, and it became InsurTech, but it's really just technology for insurance companies. And I've been doing that for a long time out of India. And then we've kind of added the insurance company to that, so that we can actually deliver a complete range of products to the customers. We have offices in London and in New York, so that gives us a kind of global footprint. The key thing, as I said, with us is the ability to be able to say yes to our customers. When I started off the program, building this company, one of the tough things is all very exciting, and you go off and see an insurer, you'll tell them all about the program and all about the client, and they would say, oh yeah, this sounds really great, up until the point of yes, we can do it, and signing a dotted line. They would suddenly say, no, they can't do it. They've been to compliance, they've been here, been there, and they can't now do it. And mostly it's because of lack of data. And we've developed techniques and processes to overcome the lack of data. And we're willing to take the risk and work with our customers to grow expertise within these new fields and these new sort of processes. And as you know, the driving force behind all this is really the mobile phone. It's the the new businesses that are cropping up, that everything gets embedded, and we are sort of our mission really is to see the insurance industry grow. And you heard a number of 2.5 trillion for one part of the insurance industry. Overall, globally, the insurance industry is about $6 trillion. And yet the penetration of the insurance industry amongst most people in the world is very low. So we believe that we can double the size of the insurance industry, and the insurance industry should be developing new products to do that. And all that extra product, all that extra, say, $6 trillion will be digital, and it will be, put and sold through technology and using technology. So this is a huge opportunity. And we believe a big part of this will be embedded kind of micro insurance.
Thanks, Harry. Whilst we're waiting for Milan to join, we have a small video for Box Insurance. And if Milan is not able to join, we have a very able replacement in Prashant, also from Box. So Prashant, if I can just welcome you on stage, please. We'll just pay Box. Now that's what I call a very, very snappy video and timing to perfection, Milan. You couldn't have timed that any better. You want to say a few words?
Sure. Okay. Thank you very much. This was by design. The music was meant for a purpose. I was to give a grand entry. Sorry, guys. I was running another session next door, so it took me a while. We had an overrun. But Shankar, thank you very much for having us on the panel. Hopefully, the video give you a sense about who we are, what we do. We are basically a global InsurTech company. Started a humble beginning in Toronto in Canada in 2018 with an ambition or a vision to make the digital world safe and secure. And as a stated intent, our focus is largely on individuals, homes, and small businesses, largely because we believe that the enterprise world has the tools, resources, people, money, investments to kind of secure themselves. And it is these people in a connected world who are far more vulnerable. So how do you build a far more, I would say, holistic cyber solution, like a one-stop shop, for want of a better word, which goes all the way from predict, prevent, respond, insure. So what we're doing is, basically, we have a B2B2C model. We work with enterprises, especially affinities, partners, who are having a large consumer base, who effectively they believe they see the relevance of digital, or they play in that space, either they're digital first or they are very payments oriented and focused. And with those partners, the idea is to create more thematic, relevant, and bespoke propositions that they can take to their consumers, all the way from education awareness to more feature-rich products, app-based products that they think could be relevant to make them digitally more confident and secure. So that's what we do as Box. Our journey in India started about 15 to 18 months back. In the last 12 months, when we commercialized the business, we today have close to about 12 contracts working with insurers, consumer tech companies, telcos, and the intent over here is to work with them, create the solution and take to market. In the last 12 months, we've now, like I said, 12 contracts, but effectively done about close to 400,000 policies. So the tailwinds are strong. I was just mentioning next door is that it's interesting where cyber is today. Cyber or digital footprint touches all parts of our lives, whether it is personal, professional, we are out sort of consuming things, or whatever it is, it touches our lives, and our ability to then hence create more relevant products at those moments of truth is where we are trying to take it to consumers. Very early days, we are learning as we go. And our partners are challenging us each day to kind of come out with more interesting, innovative solutions. But yeah, very interesting landscape. So I just thought just something about us.
No, thank you. Thanks, Milan. And ladies and gentlemen, I think if you see the panel here, they cover from not only cyber, but then you've got NatCat kind of events, which are, again, something that India is very heavily exposed to microinsurance, which again is a need of the hour, embedded insurance and things like that, which are all products and solutions that are very apt for our marketplace. And this is where I think our Lloyd's alumni, the Lloyd's Lab alumni are keen to work with you. They want to talk to you. You feel free to reach out to them after the session to try and see how you can collaborate, a partner with each other in terms of what it is that they can offer you and you can offer them, etc. So if I can just come to you, James, given that you were the first one and you've had enough rest, James, Rendell, sorry. The Indian market is very heavily exposed to NatCat events, right? We have a NatCat event of some sort that's affecting some part of the country throughout the year. And the insurers equally have got a significant exposure. Well, the insured losses in some states are far less than the economic losses of that state, purely because of the low penetration rates that we've got, etc. But if I were to ask you, how should the insurers be looking to model some of these losses in order for them to kind of minimize the losses that they suffer? Do you think that there are some challenges here that you've learned from other countries, in developed countries like the US or somewhere else, where you've seen, UK even for that matter, where you've seen that the modeling of these events is far more granular, which allows the insurer to get a reasonable level of understanding compared to where you see the Indian market?
Okay, if I understand your question correctly, I think, okay, firstly, insurance companies, it is critical that they model and do their best to calculate the likelihood of X wildfire, X flood, because it means the premium is priced correctly. And that benefits both the insurer and should benefit from the client. I think the main thing that is abundantly clear is that technology is just becoming cheaper and faster and more available to everybody. So if we look back even 5 years ago, and I look at the modeling software that most insurers were using, it was massively expensive. Not that many people had access to it. And you needed a team of people to run large natural catastrophe models. I think, like all technology, look at your smartphone, look at what it looked like 10 years ago. It probably wasn't very smart. And I think that's exactly the same with natural catastrophe modeling. It's not rocket science. It's just, we have cloud computing now. We don't have physical servers in our rooms. And the point I'm trying to make is that more insurance companies have immediate access to natural catastrophe modeling, whether that be modeling natural hazards in India, whether that be wider across the APAC region. More availability, better modeling should help premiums be better priced. Natural catastrophe modeling is not a crystal ball into the future. Otherwise, I'd be doing an insurer's job for them, which I wish. It is the best that statistics and maths are going to give you when trying to calculate and price a premium. And I think, as I mentioned when I was talking earlier, that hazards, natural catastrophes are the biggest driver of losses across all non-life casualty or cyber lines of business. It's pretty important, to say the least.
Yeah.
And I think that answers your question.
No, it does.
In a roundabout way.
Actually, pretty well, actually. But thank you so much for that. And ladies and gentlemen, let it not just be us talking. Feel free to ask your questions if you have. I will keep glancing towards the audience. let it be an interactive session as much as practically possible. Well done. Here we go. A couple of questions from the audience. Somebody pass the microphone to them.
Hi, Vraj this side.
Can you speak up so the others can hear?
Hello.
Yeah.
So when you talk about cat or net cat events,
Yep.
so worldwide, it's really uncertain what's going to happen tomorrow.
Yep.
Like you're going to die. So when it comes to pricing, what is the probability of reinsurance company or insurance company being bankrupt? Because if that happens, that's a big havoc. Correct? Because in COVID it happened. I'm sorry, but in COVID it happened. Many reinsurer companies got bankrupt and they got wiped out.
Well, I suppose what I say to all of our clients is that modeling is just one part of your underwriting strategy. It's not going to, as I said, it's not going to solve your problems in terms of pricing. It's just one part of your underwriting strategy. There is the reinsurance you buy, making sure you're properly capitalized, how you spread risk across a portfolio. You don't write all your risks in, let's say, the west coast of Florida, because others you'd have been wiped out during Hurricane Milton. It's one little part, and our role is to fill that little gap. I can't speak to reinsurers or insurers going bankrupt. And Birdseyeview is there to help that. And it's just one piece of the puzzle. So it's spreading your risk, your portfolio management, you're buying your reinsurance, maybe going to Benedict.
I was going to say this. I was going to sneakily chime in here. So I mean that's very much our wheelhouse. So once James and companies like him have done the wonderfulness with modeling, a sophisticated insurer should have a sense of how much risk they want to retain on their books and how much they want to transfer. And what we offer is alternative ways of doing that. So sometimes we work with large corporates and they're transferring their risk directly to our investors. But most of the time we're working with insurers and reinsurers who are trying to protect themselves from the exact scenario that you mentioned, these kind of really big catastrophic risks that can cause bankruptcies. Our entire market, the ILS, the insurance-linked securities market, emerged out of Hurricane Andrew in the 90s, where there was this huge, massive loss that caused a lot of insurer bankruptcy. So really our mission is to figure out how to prevent that, and it's all about risk transfer. So insurers transferring to reinsurers buying retro protection, and then transferring that risk out of the insurance world to other financial institutions.
Because in the past, I'm sure it must be happened where reinsurers are getting bankrupt. Secondly, in a day, a bank like Lehman Brothers got wiped out. So, I mean, this is true and it can happen in near future too. And not wishing for it, it can be a crisis worldwide, like Lehman Brothers.
So there's no zero failure regime across any regulatory framework, right? So at the end of the day, let's not underestimate the role of risk management policy and strategy at every entity level. So even at the reinsurer level, it's their responsibility to try and ensure that they have the right kind of risk management policy and framework so that they, again, the whole point of risk reinsurance is diversification of risk. So you don't put all your eggs in one basket. You try and spread it as far and wide as possible so that if there is one failure, then that failure is as minimal as practically possible. But again, it's a question of how frequently you monitor that reinsurance asset that is there, that you effectively wait until the failure happens and then you say, oh my God, what do I do in this scenario? So the people have been learning lessons from what's been happening as well, and then they kind of try and evolve from that as well.
Do you feel justified revising rates only once a year?
Sorry, I missed that.
Do you feel revising your rates, the CAT treaty, bonds, etc.? Do you just put out the rates for a year, right? It's a treaty for 1 year. Is that true?
We're not providing any rating. All we do is provide you with what is the probability of a flood occurring in every 10 years, every 50 years, every 100 years. That's what we do. And in terms of how often we update that, every day, because there's new data being fed into the model. I've got today's weather, I've got tomorrow's weather data going into the system. That will update the model. There's El Nino, La Nina, all that kind of stuff. So we don't drive, we sort of inadvertently drive the rates because the insurers use our probabilities or percentages really to feed into their rates. So for the Coldplay concert coming up, if we said there was a 0.5% chance for flood, they would feed that in, they would load up on top of that. So we don't provide the rates, but maybe inadvertently we do. along with probably everyone else. Anyone else that provides data that feeds into an insurer's pricing and knowledge and all of the above.
Yeah. The gentleman at the back. Sorry.
Hi everyone. So just a general question. I'll leave it to any one of you to answer. So I just have a couple of things. Right now, we are basically talking about technology, right, and how it's going to enable to make insurance business easier for capturing customers, right? So I wanted to understand that all of you from developed nations, and in a country like India, or basically even countries like in Africa, where the people are still the affordability is the key aspect, and people who are getting employed, right, to actually sell are getting redundant from whatever form, be it in the sales force, be it on underwriting, be it in legal. So, is it a wise thing to try to encapsulate all the technologies that are there in the developed nations currently and try to enforce it on nations where it is not actually developed from the workforce perspective?
Can I take that, if that's okay? So basically, I think a couple of things here that we need to bear in mind. What we're talking about is the role of this role that the technology plays, one in terms of how you can better underwrite and better understand your risk, better model the probability of an event happening and what is the severity of that event happening. There's also a role that technology plays in terms of you being able to distribute your products better, simplify your products as practically possible. But at the same time, what this is not trying to do is to replace your workforce, because what I think, if you've seen what the IIA chairman and even the IFSCA chairman was talking about today, the level of penetration here is still very low. In terms of non-life, it's barely 1%. I think if you then look at how the insurance market here has been growing at the rate of roughly 15 to 16% year on year, and is forecast to grow another 15 to 16% year on year for the next 5 years. I think a Swiss Re report kind of sets out that India will become the 6th largest insurance market globally in 2030. So that is, now if you just look at where the demographics are, most of the sales force and insurance companies, etc., are very much in the tier 1 cities. In order for you to take it into tier 2, tier 3, and into the rural sector, it is going to require a significant amount of workforce, distributors, etc. So I think the role that these people play in terms of bringing that penetration levels further is going to be significant. And I think somebody mentioned about Bima Sugam and Bima Vistar and products like that that are going to come into the marketplace, which are under the government schemes. Those are all going to require a massive amount of workforce as well. So it's not about the developed world has kind of, the markets that these guys represent are bringing products that can actually better enable us to better underwrite and better price our products, and therefore offer better solutions to the public here. That's all, not to replace your workforce.
I think it's also worth making the point. If your total net worth is $1,000, right? All you have in the world is $1,000. Maybe all you have in the world is $100. If you lose that, that's a huge problem. As a consequence, you're actually willing to pay quite a lot more than the actual probability of losing it to ensure that doesn't happen, which creates some very large margins. The issue comes that, let's say it's a 1% chance of something happening that means you lose your $100. If you pay $3 a year now, you never get wiped out because someone says they'll come in and fix you. But the insurance companies that we work with, they couldn't possibly issue that $1 policy, that $3 policy. There wouldn't be enough margins on it. If you have, if they can roll that information up, if they can take all of those individual policies, because the numbers, the arithmetic, the location of the risk, the amount of the risk, that's all numbers. That's not, that doesn't need translation. And so then if that can roll up, that brings in that extra capacity. It means that suddenly people can offer that $100 policy for $3, and that can then be sold by someone in the village potentially using their mobile phone. And there's a company called Blue Marble in Africa that's done a lot of work on this. But the company I used to work for, Hamilton Insurance Group, they provided the reinsurance to that. So the Blue Marble was being sold locally by people that lived in Africa to provide agricultural products for those like hundreds of $1,000 policies?
Yeah, so this is exactly what we do, and we do this globally. Sell insurance products. I think even in America, we sell them for like $16, 16 cents a month. Can sell products and make a lot of money on these things. And the technology is the enabler, it's not the AI and all these things. These are the enabler to grow this market from what it is today. Like you say, 1% penetration of GDP, which is quite low. Get to 5, 10, percent in. But the only way that's going to happen is technology and you enabling it, and this will, and this is what we do. Mobile phones, feed, or AWS, and all these sorts of world to sell the products, and you are looking at pricing them dynamically. Those things happen in that month. Things happened on that trip, and we keep track of the pricing so that the actual pricing kept current and relevant for those people. And it's not just selling the product, because in many ways selling the product is very, very simple. That's the easy part. Hard part is the claims and paying the claims to the people very quickly and very, very simply. And that's the bit that we spend a lot of our time in. How we're going to design the product to pay the claim. No point having a 400-page, worded insurance policy, because you're never going to be able to pay a claim on that in a minute. That's what we pay claims very quickly. That's about designing the products very simply. And it's not just technology. One of the biggest barriers really is the clients that you have to go through. And we want to encourage India to expand the market, to allow new people to come into the market and be able to sell insurance directly, just like they do in, say, America. There's a thing called a cover holder process in America, kind of regulated with Lloyd's. It's backed by Lloyd's, and it'd be lovely if we could come here and bring our innovative products and encourage more people, to become a cover holder, so that the Lloyd's market could expand. Because at the moment we have to go through a fronting company, and you've got all these sort of friction. You do about taking friction out of the market, and that's what also need to be taking friction out of the market. The regulators as well. Use of all this great technology that's there now.
But it's a point well made in terms of, you can't just take a product that's working well in a developed economy or a jurisdiction and then just simply roll it out here. It needs adaptation. It needs to be modified appropriately, etc. But so thank you very much for that.
One more question.
Okay, I've
Yeah.
got 6 seconds left.
Yeah. So basically, I also wanted to understand, for example, insurance, right? So you have the political bodies that do impact your decision making, certain aspect. For example, the war in Ukraine, right? So marine insurance did get impacted in a big way because the oil was not being allowed to get shipped from Russia, right? For various reasons. So I just wanted to understand that when you have such kind of rules and regulations that suddenly hit you, right, as an insurance company because of government policies, for whatever reasons, how does that impact our decision making? And do we have a central body, something like the United Nations or NATO, for the insurance perspective, where you sit and analyze what are the next rules and regulations, and which are equally powerful for dictating terms?
Again, I can step in on that. So there is a body called the International Association of Insurance Supervisors, which essentially is a body of all insurance supervisors around the world. And what they do is to every year they sit and get together with all the supervisors and essentially say, what are the emerging trends in the industry within their own jurisdictions as well as what they see globally. And then they try and come out with the appropriate, what they call core principles in terms of what every other regulator needs to adopt or aspire to. So they publish certain standards which are not obligatory on any of the insurance regulators, but they publish certain standards. But equally, what happens is the IMF carries out what they call a financial sector assessment program, where they come and assess every country around the world against. So they basically say, what is your regulatory framework? How much of it is it in compliance with the insurance core principles that the IIS have got? And therefore, have you complied? Are you partially compliant? Are you not compliant, etc.? And then they provide a score, which is only at the moment it's shared only to the relevant governments and the ministries. It's up to them to then decide whether they want to publish it or not. But there is, as you said, every year this exercise does happen. In fact, that body meets every quarter. But there's an annual event when everybody kind of gets together.
Thank you.
Okay. On that note, and I've got this big red thing that sits here saying time's up. But thank you very much, ladies and gentlemen. And if I can just request you to kindly show your appreciation to my wonderful panel. Thank you.